This week in gold. Gold just clocked in at over $3,000 an ounce, but it didn't last. A global sell-off sent prices spiraling, and this time, gold didn't act like its usual self. Why? It has everything to do with politics and power. The US hit China with aggressive new tariffs, and China fired back with a 34% strike on American imports. Now, markets are spiraling, and the usual rules aren't working. Meanwhile, central banks are quietly stacking more gold, while some traders are cashing out. Who's right? In this video, we break it all down. Why gold dipped, and what it really means. What the COT report reveals about institutional moves. Why April 10th could trigger the next big move. You're watching Don Gilded, where we chase the metal, not the hype. Gold price update. As of Friday, April 4th, gold closed at $3,037.36 per ounce, down about 1.54% on the day. 4,281.50 Canadian dollars per ounce. 2,375 pounds per ounce. This week's movement snapped gold's record-breaking run over the past 2 weeks. So what's behind the slide? On Friday, a global market sell-off hit hard, triggered by President Trump's unexpected and aggressive new tariffs. The stock market shook, and surprisingly, so did gold. Normally a safe haven, this time, gold was caught in the liquidation wave. That's your first red flag. When gold sells off during chaos, it means traders are either covering losses elsewhere or repositioning for something bigger. And that begs the question, is this a dip to buy or a signal of something worse? You can almost hear the algorithms groaning. The moves don't make sense, unless you understand how smart money thinks. Big players don't chase headlines. They chase exits. And gold is the cleanest exit in a dirty room. That's why dips don't scare them. They reload. Geopolitical tension, heating up fast. Just hours after Trump's announcement, China retaliated with a 34% tariff on all US imports, set to go into effect April 10th. That's not just a political move. That's an economic shockwave. It puts new pressure on everything from supply chains to corporate earnings. And it throws uncertainty into global markets. And gold? Gold usually thrives on uncertainty. But this week was different. Why? Because we're in the middle of a shift. A possible new cycle where gold isn't just reacting to fear. It's reacting to liquidity. And liquidity is drying up. Fast. Rates are still high. Debt is still growing, and cash, the lifeline of most market players, is under pressure. So what happens when everyone wants dollars and doesn't trust them at the same time? That's where gold lives. And don't forget, even the dollar has an expiration date. Every fiat currency does. The question isn't if, it's when. Gold doesn't expire. Quick historical context. Every time a trade war has escalated, gold has eventually surged. But it doesn't always react immediately. In 2018, gold dipped for months while tensions built, then surged nearly 20% in under a year. During the 2008 financial crisis, gold initially dropped when markets crashed. Not because it lost value, but because investors needed cash. Fast. What followed? A historic rally. Gold doesn't always lead the panic. It leads the recovery. So while the price dropped this week, the long game is still in motion. And it's not just the macro picture, it's the personal one too. If you were holding gold through any of those cycles, you were better off than most. Because when the smoke clears, the value that survives isn't printed. It's pulled from the ground. That's the kind of truth most people only learn once. You already know it. Now it's about remembering it when it matters most. Europe, Mercosur, and the farming frontline. Meanwhile, over in Europe, France is pushing for an emergency brake clause in the EU-Mercosur deal. Basically a panic button to protect its farmers. What does this have to do with gold? Trade deal breakdowns between major blocs are a signal. The world is becoming more fragmented. That's not good for currencies, but it is good for metals. Every tariff, every blockade, every supply chain break is a vote of confidence against paper. And gold doesn't need a passport. Australia's Port of Darwin. Sovereignty in action. Both major parties in Australia are now pushing to reclaim the Port of Darwin from Chinese control. Why? National security. Again, you might not think a shipping port has much to do with your gold stash. But this tells us something big. Governments are starting to think like gold stackers. They want sovereignty, control, tangible assets. Sound familiar? They're reading from your playbook now. Central banks. Still buying. Despite market panic, central banks aren't slowing down. In February alone, they bought 24 metric tons of gold. Poland led the way with 29 tons. China, Turkey, Jordan, Qatar, and the Czech Republic all made purchases. That's not investing. That's insurance. They're not betting on profits. They're preparing for a world that doesn't trust paper. And if the institutions with the deepest pockets are buying gold at record levels, that's a loud signal, one that's hard to ignore if you're paying attention. COT report, futures market at a glance. This week's COT report showed a slight uptick in short positions from hedge funds, but long-term sentiment remains positive. Smart money isn't running from gold. It's rebalancing. Why? Because volatility is back. And when markets get wild, big players don't panic. They reposition. We've seen this before. In mid-2020, just before gold hit its then all-time high, institutional short positions rose briefly, only to flip bullish weeks later. These moves don't spell doom. They spell timing. That's the dance in gold markets. Hesitation, positioning, then breakout. And right now, we're at the pause before the step. If you're tuned in, this is when you sharpen your edge. Because when the move comes, it'll come fast. So, what now? Gold had a wild week, from record highs to sudden drops, all within a few days. But here's what hasn't changed. Central banks are still stacking. Geopolitical tension is rising. Inflation is real. Paper trust is breaking. And that's where you come in. Every week that passes makes one thing more obvious. Gold isn't just a hedge. It's a stance. You don't need to panic when prices dip. You need to understand why they dip and what comes next. Looking ahead to next week? In our last episode, we told you to watch for a potential escalation between the US and China. And now it's here. But it's not over. The key date is April 10th, when China's 34% retaliatory tariff officially hits. If markets don't like what they see, gold could rebound sharply. Also worth watching. US inflation data for March is expected next week. If CPI comes in hot, gold could break out again. Fed minutes are due midweek. Any signal that rate cuts are off the table could drive new fear. And remember, geopolitical surprises rarely give you a warning. So stay ready, stay informed, and don't forget, this is a marathon, not a minute chart. This was your gold recap. If you found this helpful, hit like and subscribe. Share it with someone who needs a reminder. In a world of noise, gold is quiet. And in that silence, there's truth. Stay smart, stay sovereign. I'm Don Gilded. See you next week.